Something extraordinary is happening in global markets right now, and if you're not paying attention, you might miss the biggest wealth transfer of our generation. While everyone was watching tech stocks soar and Bitcoin hit new records, the smartest money in the world was quietly moving somewhere else. Central banks, billionaire investors, and institutional funds have been rotating massive amounts of capital into gold and silver, and this isn't just another investment trend. This is what experts are calling the capital rotation event. In just the past 12 months, gold has surged 88%. That's impressive. But silver? Silver has exploded by 260%. These aren't normal numbers. These are the kind of returns that define generational wealth shifts. And here's what makes this so fascinating. While precious metals are breaking records, we're seeing something we haven't seen in decades. Retail investors are pouring money into stocks at all-time highs. $48 billion flooded into US stocks in just 21 days. History shows us that this kind of euphoric buying usually happens right before major market peaks. It happened in 1999 before the dot-com crash. It happened in 2007 before the financial crisis. Today, I'm going to show you exactly what's driving this historic rotation. We'll explore why Bitcoin, the so-called digital gold, has crashed 52% from its peak. We'll look at why central banks are buying physical gold at the fastest pace in decades. And most importantly, I'll explain what this means for your wealth and how you can position yourself before this rotation accelerates even further. Let's dive in. To understand what's happening right now, we need to talk about what financial experts call a melt-up. And no, a melt-up isn't the same as a bubble. A melt-up happens when asset prices rise sharply, not because the economy is healthy, but because the currency is losing value. Investors flee into hard assets. Gold and silver rise fastest. Real estate might look strong on paper, stocks might hit new highs, but underneath, the foundation is cracking. Think of it like this. Imagine you're on a ship that's slowly sinking. The top deck looks fine, people are partying, music is playing. But below the waterline, water is rushing in. The smart passengers aren't partying. They're quietly moving to the lifeboats. That's exactly what we're seeing in financial markets today. The lifeboats are gold and silver. Mike Maloney, one of the world's leading precious metals experts, has been tracking this for decades. He's identified 3 phases in every major bull market for precious metals. Phase 1 is the stealth phase. Only the smart money buys. Prices move up slowly. Nobody pays attention. Phase 2 is the awareness phase. More investors notice, prices accelerate, media starts covering it, but most people still don't believe it. Phase 3 is the mania phase. This is where you see the greatest gains in the shortest period of time. Everyone rushes in, prices go parabolic, and this is where life-changing wealth is made. According to Maloney and many other analysts, we're entering Phase 3 right now. The evidence is everywhere. Gold just crossed $5,000 per ounce. Silver cleared $80. And major investment banks are revising their forecasts upward. JP Morgan Global Research is now forecasting gold to average $5,055 per ounce by the final quarter of 2026. By the end of 2027, they expect it to reach $5,400. But here's what's really interesting. These forecasts might actually be conservative. Let's talk about what's really driving this rotation. And it starts with something most people don't understand: the difference between paper metal and physical metal. When you see the gold or silver price on your phone or computer, that's the spot price. But here's the secret. That price is largely determined by paper contracts, futures contracts, exchange-traded funds, derivatives. These are promises to deliver metal. But most of these contracts never result in actual physical delivery. Think about it like a bank. When you deposit money, the bank doesn't keep all that cash in the vault. They lend most of it out. They keep just a fraction on hand. This is called fractional reserve banking. It works fine until everyone shows up demanding their cash at the same time. The precious metals market works the same way. There are estimates that for every 1 physical ounce of silver in a vault, there are 300 paper ounces traded. Some analysts believe the ratio is even higher: 411 paper silver ounces for every real ounce. This is the kind of setup that leads to what Mike Maloney calls unaffordium. This is when physical gold and silver prices start to diverge sharply from the paper spot price. Real metal becomes much more expensive than the quote on your screen. Premiums explode, delivery times extend, and suddenly the paper price becomes meaningless. We're already seeing early signs of this. Bullion dealers are reporting supply constraints. Premiums on physical coins and bars have increased significantly. The US Mint has struggled to keep up with demand for silver eagles and gold eagles. Why is this happening? Because when the smart money rotates into precious metals, they don't want paper promises. They want the real thing. They want metal they can hold, metal they can store, metal that can't be printed or created out of thin air. Now let's look at who's buying and why that matters so much. Central banks around the world are accumulating gold at a pace we haven't seen in decades. In 2022, central banks bought over 1,000 tons of gold. In 2023, they bought over 1,000 tons again. In 2024, the buying continued at historic levels. These aren't small purchases. We're talking about hundreds of billions of dollars worth of gold. And here's the key detail. These central banks are mostly from emerging markets and developing economies. China, Russia, India, Turkey, Poland, Singapore. Why are they buying? One word: de-dollarization. For decades, the US dollar has been the world's reserve currency. Countries held dollars and US Treasury bonds as their primary reserves. But that's changing, and it's changing fast. The United States has a debt problem. Total federal debt is now over $34 trillion. That's trillion with a T. Every year, the government spends more than it takes in. The deficit for 2024 alone was nearly $2 trillion. To fund this deficit, the US Treasury issues bonds. But here's the problem: fewer foreign buyers want those bonds. Why? Because US fiscal policy looks increasingly unstable. The dollar's purchasing power keeps declining, and the risk of holding massive amounts of US debt is growing. When foreign central banks don't buy enough bonds, someone has to. So the Federal Reserve steps in. They create new dollars and buy the bonds themselves. This is essentially printing money, and when you print money, it loses value. Central banks around the world see this. They understand what's coming, so they're diversifying away from dollars and into gold. Gold can't be printed. Gold has no counterparty risk. Gold has been money for 5,000 years. This is why the central bank buying is so significant. These are the ultimate smart money players. They have access to the best information. They plan decades ahead, and they're moving into gold in historic quantities. But central banks aren't the only ones making this rotation. Retail investors are waking up too. Remember the Wall Street bets movement? The Reddit crowd that squeezed GameStop and other heavily shorted stocks? Well, there's a similar movement in silver. It's called Wall Street Silver. This community calls themselves silverbacks and apes. Their homepage features an army of primates marching, inspired by the Planet of the Apes movies. They organize raids, which are coordinated buying days where thousands of people buy physical silver at the same time. The original silver squeeze in early 2021 caught a lot of attention. The price of silver spiked. Dealers sold out. The movement exposed some of the weaknesses in the paper silver market. Now they're planning another squeeze. But this time, they have more experience, more coordination, more members. The Wall Street Silver subreddit has grown to over 200,000 members. They're not going away, and they're accumulating physical metal every month. This grassroots movement matters because it represents a shift in investor psychology. These aren't institutional players. These are regular people who have lost faith in the traditional financial system. They believe big banks have manipulated precious metals prices for years. They see gold and silver as a way to opt out of a corrupt system. Whether you agree with their worldview or not, their actions have real impact. When hundreds of thousands of people consistently buy physical silver, it affects supply, it affects dealer inventories, it affects premiums, and ultimately, it affects price. Let's talk about silver specifically, because silver might be the most interesting opportunity of this entire rotation. More than half of annual silver demand comes from industrial uses. Solar panels, electric vehicles, electronics, data centers, 5G infrastructure. Silver has the highest electrical conductivity of any element. It's irreplaceable in many applications. As the world pushes toward clean energy and electrification, silver demand has surged to record levels. The Silver Institute projects that industrial demand will continue growing for years to come. Electric vehicles alone will require massive amounts of silver. Each EV uses anywhere from 25 to 50 grams of silver. As EV adoption accelerates, silver demand accelerates with it. Meanwhile, solar panel production requires significant silver. Each solar panel contains about 20 grams of silver. As countries race to meet climate goals, solar installations are breaking records every year. Here's the problem. Silver supply isn't keeping up. The silver market is on track for a fifth straight year of supply deficits. That means more silver is being used than produced. Every year, global above-ground stockpiles shrink. Unlike gold, which is mostly held and rarely consumed, silver gets used up. It goes into products. Those products get thrown away or recycled inefficiently. That silver is gone. This supply-demand imbalance is why many analysts believe silver has the potential for even bigger gains than gold. Some are predicting triple-digit silver prices, $150 per ounce, $200. Some even forecast $500 per ounce if we see a true supply squeeze. These aren't random guesses. The gold-to-silver ratio, which measures how many ounces of silver equal 1 ounce of gold, is historically out of balance. For most of history, that ratio averaged around 15 to 1. Right now, even with silver's recent gains, the ratio is still around 60 to 1. If that ratio returns to historical norms and gold continues rising, silver would need to be trading at over $300 per ounce. That's a 400% gain from current levels. Now let's address the elephant in the room: Bitcoin. For years, Bitcoin advocates called it digital gold, a store of value, a hedge against inflation, the ultimate safe haven asset. But something interesting happened. When real uncertainty hit markets, Bitcoin didn't act like gold. It crashed. Bitcoin is down 52% from its all-time high. Most of that decline happened in just 1 month. Meanwhile, gold and silver are making new highs. What happened? Why did digital gold fail its test? The answer is that Bitcoin isn't actually like gold. It's a speculative technology asset. When risk appetite is high, Bitcoin soars. When fear enters markets, Bitcoin gets sold along with tech stocks and other risky assets. Gold, on the other hand, has 5,000 years of history as a safe haven. When uncertainty rises, people buy gold. When currencies weaken, people buy gold. When geopolitical tensions escalate, people buy gold. We're seeing this play out in real time. Investors are selling tech stocks like Nvidia. They're selling Bitcoin, and they're buying gold and silver. This doesn't mean Bitcoin is worthless. It has its use cases. Blockchain technology is innovative. But Bitcoin is not a substitute for precious metals. It's a different asset class entirely. The fact that Bitcoin is selling off while metals are soaring tells us something important. This rotation is about safety. It's about protecting wealth. It's about owning assets that can't be hacked, can't be censored, and can't be created out of thin air. So what does all this mean for you? How should you think about this rotation? First, understand that we're in unprecedented times. Government debt is exploding. Central banks are trapped. They can't raise interest rates enough to control inflation without crashing the economy. So they'll keep printing, and when they print, hard assets rise. Second, recognize that this rotation is still early. Yes, gold and silver have already made significant gains, but if we're truly entering phase 3 of this bull market, the biggest gains are still ahead. Third, consider the difference between paper and physical. If you want exposure to precious metals, owning physical gold and silver gives you the most protection. Exchange-traded funds and mining stocks have their place, but they come with counterparty risk. Fourth, think about silver's potential. With industrial demand rising, supply deficits growing, and the gold-to-silver ratio still historically high, silver might offer the best risk-reward opportunity. Fifth, don't wait for perfect timing. In phase 3 of a bull market, prices can move very quickly. Trying to time the exact bottom is less important than having exposure before the mania phase really kicks in. The global wealth rotation into gold and silver isn't a theory anymore. It's happening right now. Central banks are buying. Institutional investors are rotating. Retail investors are waking up. Supply is tightening, and prices are accelerating. History shows us that these rotations don't last forever. They happen in waves, and the final wave, the mania phase, is where the most wealth gets created in the shortest time. You now understand what's driving this rotation: fiscal instability, currency debasement, de-dollarization, industrial demand, supply deficits, and a growing recognition that paper assets carry risks that physical assets don't. The question isn't whether this rotation will continue. The question is how much further it has to go, and whether you'll be positioned to benefit from it. The smart money has already moved. Central banks have made their choice. The rotation has started. The only question left is, will you join them? If you found this information valuable, please subscribe to the channel. Share this video with anyone who needs to understand what's happening in markets right now. And leave a comment below telling me what you think about this rotation into precious metals. Thank you for watching.